This is Joe Pryor of the Virtual Real Estate team in Oklahoma City. In the last few days, I've done two videos on investing in Oklahoma City real estate. I touched on why Oklahoma City is such a good market, why Forbes rates it as the third best job market, why our economy is stable, a positive cash flow market, low taxes, low housing prices, a non-bubble market. I also talked about two different types of investments investors can do in real estate, which is first, short sales. They're really good values here. They give you equity, they give you positive cash flow, give you good long-term return on investment. I also talked about VA financing on their foreclosures, which is 5% down. Now there's a Fannie Mae program I was going to talk about, but in the last few days on these videos I've had some questions. And the questions are, how do you select an investment? How do you know one's better than the other? What do you do to give me the best possible buy I can have? Now, the first thing you need to know is something about your own market. And as I look at real estate markets in the United States, I see three types. I see linear markets, cyclical markets, and hybrid markets. A linear market is like in Oklahoma and Texas, especially in Oklahoma City, which is where you have steady appreciation or you have not high highs or low lows. In other words, no, you're not going to get 15 or 20% appreciation, but you're also not going to see your product dumping away with a 20% loss of value. That's a linear market. It's very predictable, it's very steady, it's very good for conservative investors. It's not good for flippers because you need more margin than that, but long-term investment is very good. California and Florida historically have been cyclical markets. Now we need to throw the bubble out. That was an artificially created market that defied normal market conditions, and so if you go back to their regular markets, they will have a sawtooth line. In other words, you'll see it spike and then you'll see it drop. And then Phoenix is a hybrid market traditionally where it kind of plods along and then all of a sudden it may have those jagged sawtooth edges of highs and lows and then back to its normal market. So first of all, Oklahoma City is a linear market. Then we look at supply and demand. What type of demand do we have? In other words, is it condo? Is it single family? In Oklahoma, primarily, that is single family. That's the kind of relocation we're getting. People want to be in a good school system. They need 3 or 4 bedrooms. Now, that may be a little different, say, in Norman, Oklahoma, where you have the University of Oklahoma. You have a high turnover rate, people coming in for training, students, etc. But in Oklahoma City and the greater Oklahoma City area, primarily it's single family. Then we talk to our property managers because we look at absorption rates in rental just like we do in selling homes. We want to know, what is the supply and demand issue? Are we oversupplied or are we undersupplied? Now, one thing that we try to do is go with the undersupply. The reason why is we want rental appreciation. There is rental appreciation and you're going to need it. If we're going to maintain a good return on investment, we have to know that taxes and insurance goes up in an accelerating market, in a market that's appreciating. So if I can get you 5% rental appreciation, I can offset any increases that you may have in taxes and insurance. Now then we go to what is quantifiable, and then this is where I get computer programs involved. And this is where I compute for you a return of investment and return on investment. Now first, return on investment is two things, and I'll go into more detail in future videos. We look at long-term wealth accumulation. In other words, if you invest $50,000, you hold a property for 7 years. Is there $150,000 at the end of the rainbow? That's one way, which is wealth accumulation. The other is called internal rate of return, and that is the money you put in and you keep it in the investment as long as you own the investment, and you even take the profits and you reinvest it either in more real estate or primarily you would put it into some kind of a cash account that gives you interest. And that's an annual computation, and we do that in a pre-tax and an after-tax manner. We do it in a pre-tax because we want you to compare it to other types of investments. Stock market, mutual funds, for instance, tax-deferred annuities, CDs. So you can see, well, if I put my money with Joe into a home as versus putting it into a mutual fund, what can I expect over that 7-year period of time? And we do, of course, do the after-tax because in that particular sense, you've got to know, okay, am I getting 14, am I getting 16%? What exactly am I getting? So we will show you what that is quantifiably. Then there's return of investment, and that is, okay, if I put that $50,000 out, how long do you think it's going to take for me to get my money back out of it? And that's something that we analyze too. So one way that we do that is what's called cash on cash. This is where I can take your investment of $50,000, give you a snapshot in that first year that kind of gives you an indication of what the investment is like. Now, in other words, do I get 10% of my money back? If that's the case, obviously that would be $5,000 on that 10% investment. Now, or that $50,000 investment. So the reason why that might be important is if we have two good returners on a long-term basis, and you also have to remember that 7 years is an estimate, and there's probably appreciation, there's vacancy rate, there is all sorts of things that you have to put in there that may not be accurate by the time it gets to the end of the 7. That's why it's called an estimate. But we can take that snapshot of cash on cash, and I can look at two homes and say, this one gives you 8% of your money back in the first year. This one gives you 12% of your money back in the first year. And on that basis, you might make the decision of one versus the other. Now, the last one is capitalization rate. And like cash on cash, it's used more in the commercial investment end than it is in residential investment. Although, again, it's based on net operating income. And so that is important that we kind of look at that. So when you invest in Oklahoma, you don't just get somebody saying, well, I think this is going to be a good investment for you. You're going to get from me something where I say, yes, I think this is going to be an investment that's good for you, but here are the reasons why. This is the type of market we have. This is the supply and demand of our market. This is the return on investment, and this is the return of investment. You deserve nothing less from a professional when you're going to be putting money out and taking a risk. So in the next video, I will be doing that Fannie Mae special financing just to fill that out, and then subsequent videos will go into more detail about that return of and on investment.